Welcome to the Get Real Podcast, your high-octane boost of full-on reality therapy for personal, business, and investing success with your host, Ron Phillips, because somebody's got to tell it like it is.
Hey, everybody. Welcome back to the Get Real Podcast. Ron Phillips here. Got another awesome show. I feel like I say that a lot, but I think it's true. We have really good shows. Today is not going to disappoint. Chris Miles is back on the show. Welcome to the show, Chris.
Hey, thanks for having me on. Thanks for like giving people's expectations up so high. Like, this might be a good show, right?
This is going to be a good show. This is going to be a good one. For those of you who don't remember, Chris has been on the show several times, and a good friend of mine and a good friend of the show. Chris runs Money Ripples, which is he calls himself the anti-financial planner, and for good reason. We're gonna I think today what we're gonna do is figure out why he calls himself that. But it's really good timing because there's so much upheaval in the market, Chris. People are confused about where to go. Everybody talks about the bond market in relation to the interest rates, and then the stock market's going up and down in wild swings. Bitcoin is supposed to be a hedge against all of that, and yet it followed the stock market in the last crash. What in the heck is going on, and what do people do? Let's go there.
Well, let me give you some background so you understand where I'm coming from, because although I'm a huge fan of real estate, and Ron, obviously I'm a client of your companies as well. I bought lots of turnkeys through you guys and love your stuff. I wasn't always that way. The reason I'm an anti-financial advisor now, or it's funny because I actually talked to a neighbor, told him what I did without saying the moniker. And he's like, "You sound like an anti-financial advisor." I'm like,
yeah,
that's
you're
exactly
the opposite. Complete opposite.
Yeah, like teach the opposite, right? If you're a business owner, if you're a person that actually has, a real investor, likes to make money, you're going to like me, right? If otherwise it's like the traditional stuff. And I started out being the traditional financial advisor, right? Like I went into it because I thought if I can learn about money for myself and maybe even give my dad, who was like the penny pinching saver. He was like the guy that Dave Ramsey looked up to, because he was like Dave Ramsey learned everything he knows from my dad, I swear. And so I thought, if I can give my dad some years of his life back, because he thought he would work until he died, this would be worth it. And then, of course, 4 years in, as I'm a financial advisor, I sit down with my dad for the first time. He's 61 years old. I said, "Dad, here's the deal. You're debt free, including your mortgage. You've been stuffing money in your 401k and getting that match. But if you want to retire today, you better hope you die in 5 years, because that's when you'll run out of money." Well, what do I do, Chris? I don't know. You did everything right from what I teach as a financial advisor.
Mm-hmm.
And this rocked my world, because I've been teaching clients for 4 years previous, which in the financial advisor world, 4 years is like you working like as an old timer, because most people don't even last 2 years in that industry. But I've been teaching people for years that, hey, this is the best thing. You start to save your money, throw it in your mutual funds, let it sit there forever, grow it, set and forget it. Just keep adding more money to it. And eventually someday you'll be able to live financially free, right? But here's my dad, who would have been the poster child for what I was teaching. And yet that was not the poster that I would want to be showing my clients, right? Like, it would not be a good thing to say, yeah, you got 5 years of retirement after working for 40 and saving and working your butt off for 40 years. So it was, of course, at that time when the students ready to teach our peers, I went to call one of my friends who I trained to be a financial advisor, then left to go do real estate investing, right?
Mm-hmm.
And I'm calling him up to see if he's broke yet. And he's like, "Man, Chris, my life is awesome. My dad and I have partnered on some deals and doing some fix and flips and things like that. And we've now doubled his income as a professor at the local university." Like, wait, whoa. You've only been doing this like 4 or 5 months. That's too good to be true. There's no way. I said, "Well, Chris, how many of your clients are financially free where they don't worry about money?" "Well, none. They all worry about running out of money too early, right? Or outliving their money." "Okay, well, great job, Chris. Well, how about this? How many of you guys as financial advisors are financially free, not off the commissions you're earning, but actually doing these investments?" And I was really honest with myself. There was about 100 guys in my office, and some of them have been working there since the late 1970s. This is back in 2005, right? They've been working there for like 30 years. And I'm like, well, none. I don't think any of them can retire off what they're doing. It's like, you got a clue yet? Hello? And And so it got me going down the path of real estate investing. And when I started to realize it wasn't about accumulating all this money and squirreling it away for 40 years or longer because it doesn't work, but instead getting your money to actually create actual passive income, just like you teach on this podcast here. When I realized that was the secret, right? It was about income, not about accumulation. Once I got to that point, then I started focusing on the passive income. I was able to retire later that next year when I was 28 years old. And I thought, well, dang, that was way easier than the path I was on as a financial advisor. And that's what kind of opened my eyes. And that's why I've been kind of teaching people ever since, and understand I was a stock trader. I actually traded stocks. I even taught 200 people how to trade their own stocks and options. So it's not like I didn't drink the whole stock market Kool-Aid. I would raved about it. I was telling people, hey, this is the place to be. Yet I couldn't find the proof. And even the people that are in stock trading, here's an evidence for you, Ron, because I actually referred to your company, someone who actually owned an options trading company, someone who taught people how to trade stocks and options. I referred him to you guys because he said, Chris, I'm sick and tired of not having passive income. He's like, yeah, I make money in the market, but I have to babysit this thing all the time. I want real passive income. If that's not evidence enough, what is?
I'm telling you that, and it's not that accumulation is a bad thing. Accumulation is a great thing, but if that's all you're doing, then it's hard for the income to show up when you put it into these plans that you have zero control over, and they just they do whatever they do with the shifting of the market. Plus, there's no leverage that corresponds with the accumulation of wealth, where the beauty of real estate is that you get both, and it's leveraged on both sides. And the wealth accumulation that happens dwarfs the income, but you get the income with it. It's a wonderful thing. And then if you're wise, you use that equity to continue to do the same thing you just said, Chris. So I appreciate you talking about your story. One of the things I don't think I've ever talked about, and I kind of forgot until you were telling your story. My dad used to be a financial planner. I actually started out in the financial planning world, and I didn't make it but like 6 months. And I was getting ready to do the same thing my dad had done. Go take my series, go take all the series, and start helping people with financial planning. And then I got introduced into real estate, but it was like literally 6 months. Like I just didn't really last that long. But my dad was a financial planner for a long time, and he stopped because of what you were saying. Yeah. He shut it down because he couldn't keep selling people the things that were not helping them. Right. And at the time when I was a teenager, I thought, man, this is insane. Like you have a good business going here and everything. And he's just like, I can't keep telling people to do this thing that is not working. And he went into something completely different. So good for you for just flipping the script 100% on its head, and then just saying, look, this you still need to have income, and you still need to accumulate wealth. There's just a better way to do it. But let's talk through some of the myths that are out there, because we both see this on the internet. Put your money in the money market account, put your money in the S&P, put your money in whatever the ticker is. And you just let it sit there. You just let it ride, right? What's the problem with just sticking your money and letting it ride, Chris?
Well, it can be good if it's in the right kind of vehicles, right? I mean, Ron, how many times have we seen people that bought real estate and accidentally became multimillionaires? Like they didn't know what they were doing.
All the time.
All the time, right?
People who just bought their own home, they didn't even invest in real estate. They bought a house, and over time, they became a millionaire. All the time. See it all the time.
All the time. You don't see that in the stock market. You don't see people accidentally becoming a millionaire saying like, oh, whoops. Like you have to very intentionally become a millionaire because of the very things you mentioned. So let's talk about some of those myths, because there's a lot of them, right? I'll work to the 401k last, because there's a myth of the match we'll get to later, right? But like here's the thing I always hear, right? It's always like, set it and forget it, right? Like you were just saying,
Mm-hmm.
just put it, lock it away. First, you got to ask yourself, where does all this advice coming from? Set it and forget it. High risk creates high returns is another myth, right? You get the myth of dollar cost averaging. All this kind of stuff are myths, really. They have half truths associated to them that work towards selling more of these products. Think about this. As a financial advisor, and you know this too, Ron, who did you really work for? Even though you had clients, who are the people that were always
you work for the
treating
company
you and
selling the
paying you?
product. Absolutely. You work for the company selling the product, whatever the product was,
That's right.
or products, multiple products.
Yeah. If you really trace back where all of this financial education came from, you can always trace it back to a financial institution, a bank, something of that nature, right? So like, for example, when they tell you, you got to save up all this money, you got to, use that miracle of compounding interest. It's the eighth wonder of the world because Einstein said so, which by the way, he never did. I looked up the quote. It was compounding numbers, but they twisted it to say compounding interest is the eighth wonder of the world for their benefit. So you only find it on like pretty much financial advisors' websites now. You hear all this kind of stuff, right? And they want you to do that because think about how they get paid. Even financial advisors too, in many cases, they're paid at assets under management. The more money you put with them, they charge you a fee on that money, right? And so they're making you, in many cases, at least 1% a year on that money. So if you put $100 million with them, they're making $1 million a year of income, literally doing nothing. You think that a financial advisor does anything special? No.
Which in my opinion is more fair than selling you a bunch of crap and getting a commission on it, and it's still not fair. Right. So I mean,
you make money or
of the
not.
two ways to get paid, at least one's a quote air quotes fiduciary, right?
Yeah, that's the thing. Like I think it's kind of criminal that people get paid whether you make money or not. You lose money in the market. Let's say you have $1 million sitting in your IRAs, whatever. If you're one of the rare few, but then all of a sudden the market drops 20%, you're now down to 800,000. You're like, I lost 200 grand. But then the advisor's like, oh dang, I just went from $10,000 to $8,000 a year. Shoot. They're still getting paid, right?
Yep.
That's and that's the thing. So when you think about, they tell you to save up money, and how much of you're supposed to be saving, as much as you can, right? They used to say 10%, and now they're saying, oh, that's not enough, 20%. Notice it's always our fault. That's never enough. It's not because the stock market actually doesn't return what it does. Another myth I'll get into as well. But they're telling you to do that, put it in there forever, let it compound, which also compounds their income while you just hopefully compound some interest. They tell you that when you finally do take it out, take out as little as possible so you don't run out of money, right? So take out 3% a year because the whole 4% rule was debunked a long time ago. Did you know the 4% rule was taken from using stats from 1926 to 1976? Right after we were just barely taking off the gold standard and inflation became more out of control. So,
and for those of you who don't know what the 4% rule is, it's a way to calculate how much wealth you need to be able to consistently live on a certain amount of income, right? So if you want $100,000 a year, you divide you divide $100,000 by 4%. It's going to give you the number that you need for your nest egg.
$2.5 million, right? 25 times in that case, right? Yeah. So like they'll say, oh, you have $2.5 million, you can live on 100 grand a year, right? Or if you have $1 million, you can live on 40,000 a year. The only problem is that number's been debunked so long ago. Even George Camel, who co-hosts with Dave Ramsey on his show, he did a video talking about how it should be a 3% rule instead based on all the data coming out. They're always about data on that show, right?
Yep.
Then Dave Ramsey got a caller, and the caller's freaking out. He's like, I don't think I have enough for retirement. He's like, because you guys say to pull off 3%. And Dave had this weird, odd look. I actually did a react video to it because it was so good. And Dave's like, wait, what are you talking about 3%? He's like, well, yeah, you're George Camel said on the show the other day that you're only supposed to pull out 3%. And I don't think I have enough to retire. And Dave's like, that's stupid because you make 12%. You should be able to pull off 8% a year. And so I did on my own podcast, react to that. I said, let me show you what happens when you pull out 8% a year and you have the typical market that goes up 2 years, down 1 year. Because it's usually, they call it Wall Street waltz for a reason. 2 years up, 1 year down, or 5 years up, 2 years down. It's kind of the more average, right? So I showed that with an 8% average because that's the actual real return on the stock market, not 12 like Dave Ramsey claims. And when you do that, the numbers, what happens in about 15 years, you run out of money, and I did it like with a true 8% average, with 2 years up, 1 year down. But because you start pulling out income, you pull off 8% a year, you run out of money. But Dave doesn't give a crap because Dave doesn't live off the stock market. That's the other thing I hate too. there's so many myths here, but like I'm just going to dive into a bunch of them. Because,
dude, just go to town, man, because I can't stand this either. When if you say one thing and do another thing, all of a sudden we're not simpatico anymore, man. You better be drinking the same Kool-Aid you're serving everybody else.
Oh man, I get so pissed. And this is something I see not just with Dave Ramsey. It's a lot of people in the financial world, but they'll say, well, yeah, just keep putting your money in mutual funds. You'll get there. Like he'll say, if you just save $100 a month for 40 years at a 12% rate of return, you should have $1 million. You should have $1.176 million. I should have the Twitter post because he puts it on social media all the time, even to this day. You should have $1.176 million, saving $100 a month for 40 years at 12% in the market. Everybody should be a millionaire is what he says. The problem is this. One, 12% a year on $100 a month. You do the math in the actual financial calculator, you get $979,000. Dave Ramsey's $200,000 off. Two, the market does not average 12% a year.
Nope.
When you look at the real SP 500 average, and it's highest that I've seen it in years. I've tracked it almost monthly. I always adjust it because there's always different numbers. Figures don't lie, but liars figure, right? That's the one thing I've learned. Depending on what month you pick, you can actually have a very different rate of return in the market. So you can say, oh, well, from May to May for these 40 years or 30 years looks way better than January to January or November to November. So I'm going to show this number instead, right? Well, when I track it all the time, the highest I've seen it is right now because we're at a market high. And 1994, 30 years ago, was a market low. Like the market was actually bottoming out, starting to come back up to roar through those 90s. The average for 30 years is 8.4%, not 12. And that's the highest I've seen it. Usually it's between 7 and 8%. It just has to be higher right now.
I have never met a soul who has actually made 12%. No. As a matter of fact, the majority of the people that I have met don't even make 8.
That's right.
So, because even if the stock market's doing 8, you're still paying fees to be able to get that return, which means you are sub 8. And I've never met anybody. If you actually just go back and look at their reports, they don't actually make that. The funny thing is their reports show them making 8 point whatever, but when you do the math, their money, what's actually theirs, never made 8 point whatever. It didn't do it because you have to subtract out the fees and everything else that's going on, right?
That's right. That's exactly it, Ron. Like, because for example, and some people here's real stats, real data, right? Fidelity has 45 million account users, right? 45 million, clients. Of that 45 million, and at the end of 2023, they came out with the stats. Only 810,000 had at least $1 million in their IRAs or 401ks. 810,000. That's about 1.8% of all clients have $1 million. And remember, if you're supposed to loan on 3% a year, that's only 30 grand a year. So this is why Transamerica did the same kind of survey on those same people. Transamerica did a survey, said that 35% of them said, quote, it will take a miracle for me to be able to retire. 35% of those have at least $1 million. So that means really only 1% says, I think I feel okay.
And God help you if you're trying to retire the year that the stock market crashes. Then what do you do?
That's right. That's what happened to my dad. See, my dad, he turned 60 right after Y2K. So I sit down with him at 2005. The market was just starting to come back up again. And he's like, what do I do? Like, well, Y2K kicked his butt, he definitely got affected by that and he's starting to recover. Here's the problem though. The high of Y2K hit that high once more in 2007. It finally came back to 0% from March of 2000 to right there in the middle of 2007. And then what happened right after it hit the high? Crashed, right? We had the Great Recession. The stock market never came back until 2013 to the same high that it had in 2000. And even then, because like what you said, Ron, because there's fees coming out, most people I talk to, again, real life, because everybody's speculating like, well, based on the charts and stuff, what about real life? I had people that had money sitting in IRA accounts that they didn't add any money to, right? Because it clouds it when you start adding more money to your 401k because you're supposed to dollar cost average. That's another lie. But, you're doing that. But people that had it sitting there, most people that I talked to that had money from 2000 never got their money back until 2014 or 2015.
Yep.
But with inflation, guess what? You probably lost at least half over that period of time because usually about every 12 years or so, we double inflation. So still, it's like losing 50%. They didn't actually see that money really truly come back with inflation to 0% net of inflation till about 2020, after 2020 when it roared
And
for those few years.
you think about that, right? Everybody's like, okay, well, yeah, but everything came back up. Well, those two roller coaster rides that you just discussed break somebody even after like 15 years with zero return. So this whole compounded 8, 12, call it whatever you want, didn't actually happen. It was a compounded 0%. They got no return. There was 0% growth in that person's account.
That's right.
And people wonder, they look at their accounts and they see for years and years and years they're getting these decent returns. Sometimes they are 12, sometimes they're 8, sometimes they're 10, sometimes they're 12, sometimes they're 15, and they're thinking they're doing really, really well. And they don't look at the actual numbers in their account and what the growth is actually producing. And that's really, really sad, because when you actually look back at that, there's no growth. And then you take the inflation number on that, and their money, especially over the last many years, because the inflation has been so high, like off the charts high, their money is worth so much less. They've lost so much money, so much buying power. And now when the stock market is crazy high, they've finally gotten a little bit of return. I mean, what's most likely going to happen? We're going to have another correction, and they're going to get kicked in the pants again.
That's right. That's the thing I'm warning people about, lately. I really calling out the warning call, because I called it at the end of 2021, where I said, I think we're finally ready for a market down. Like it was actually working its way. We were supposed to be working to a recession in 2019. And then all of a sudden, when COVID hit, instead of going to a big recession, we thought that would be like the whole black swan event that would trigger the recession and people would actually realize it. But no, the Feds print crap loads of money to hide it, to mask it, to really delay it and create a bigger bubble than it already had. So it was trying to correct naturally. They forced inflation. They forced high markets. The reason the stock market went up was not because the economy was strong. It's because they literally were just pumping money into the system. The money had to go somewhere, right? And so when that happens, now this is what I'm scared of, is that in the last 15 years, remember I mentioned it's generally 5 years up, 2 years down. Since 2009, we've been 14 years up, 1 year down. We are literally about 4 to 5 years overdue for down years.
It doesn't feel right. It just doesn't feel right.
No, and even when I showed the chart, I showed this on my podcast, my Money Ripples podcast recently. I showed a chart of where the market is. And I used my stock trading experience to show trend lines, right? Because the stock market does go up over time. There's no doubt. And it tends to follow a pattern. And every once in a while, like it bounces off that long-term trend line from like the 1930s all the way till now. Like 2008 actually barely hit that trend line, bounced up off of that, right? In 2009, we saw it bounce off of it in like the 80s and into the 90s and stuff. But even in the 90s, it was going above the line. And even when it came down Y2K, it didn't quite hit it. And then went up, and then it finally hit it after 2008 and 2009. Then it bounced up. Well, we're way above that line again. Like the S&P 500 is sitting around 5,400, depending on the day, right? Well, the trend line for the S&P 500, where it actually would come back into balance again before it would bounce back up, is about 1,800.
Oh my God.
It's more than, it's almost triple the height of what it's supposed to be in value right now. But yet, AI, booms and hypes and all this kind of stuff, which hasn't really generated more income, but people are all hyped up about AI, right? It's like another Y2K. Like everything's getting hyped up beyond the actual reality of what the situation is. And right now, 90% of trading that happens in the stock market are not even done by humans. It's all done by computers right now.
It's done by bots.
Literally.
Yeah, I mean, it's a little concerning. The whole set it and forget it thing, it doesn't really work. The only people that are really making any money off of mutual funds are people who are in closed mutual funds that you can't get into that return north of 20%. And the crazy thing is that the averages that people talk about take into account all of the mutual funds, including the ones you can't get into. So it's skewed incredibly high. The numbers are skewed incredibly high because those closed mutual funds you couldn't get in if you wanted to.
That's right.
Right.
And even then, I mean, they might be good one year and bad the next, right? Like you just never have any certainty with it.
The only funds that returned, crazy amounts were, I think, Bernie Madoff. And I mean, you consistently to get those kind of numbers, it's a scam, dude. The markets don't do that. They just don't do that.
Well, and that's why there's that myth of like the actual numbers, right? Because like you mentioned Bernie Madoff, even people like occasionally will tell me, hey, there's this guy that trades options in the stock market. And options, if you guys don't know, options are like a much more volatile version of doing stocks. Like everything's amplified. Your gains are amplified, but your losses are also amplified as well. I had one stock student who didn't want to wait to trade stocks because it didn't seem sexy enough to make, potentially double your money in a couple of years. He wanted to see it happen in a couple days or weeks. So he started doing options trading. He lost 90% of his money in 1 week options trading. Even worse, I had a friend who worked for a company that teaches you how to do it. TD Ameritrade bought that company out. He tried to trade his own dad's money, lost all of his dad's money in a couple of weeks, because he was a stock coach, right? He was teaching people how to trade stocks and options, and he lost it.
Unreal.
So when I hear people say, well, this guy is really good. He's going to pay me 10% a month of my money. And I said, well, kiss your money goodbye, because no one consistently gets 10% a month on options trading. How do I know that? Because if you do the math, right, just try this. Just say like, hey, I'm starting with $10,000 and maybe I'll even add $10,000 a year, right? But just start with $10,000. Go put in a compounding interest calculator, put it in there, put in 120% a year returns on that $10,000 and watch what happens. This person will be richer than Bezos in 20 years. There is no stock trader I know that can ever do that.
No.
Even Warren Buffett, his average return has been right around 24, 25%. He is heralded as the greatest investor of our time, right? Even George Soros is right around the low 20s, right? He can't even do it. So what makes you think you're going to do it too, right? Especially when you're trying to put your money with somebody. It's just bull. Where in real estate, we've seen it happen over and over and over again, right? I show this example too. I show the last 6 years, because the last 6 years in the stock market, we literally doubled in market. So I use the example of a turnkey I bought through you, Ron, when out in Memphis, I show the example there, and I always say results will vary, yada, yada, all that crap, right? But still, that period of time, we saw inflation in the stock market and the real estate market. You could argue that both were overinflated in some ways.
And still are. You could argue they still are. Yeah.
Yeah. So I said, I'll take my $32,000 down payment, which actually includes my closing costs for my real estate property. What if I put that in the stock market? I would have had in the S&P, if I just did the S&P, not like what you said, most mutual funds that don't even keep up with the S&P, because most people now are arguing, well, I just put my money in the S&P 500 because it's way better. And they're right. It is. But despite that, I put it in the S&P 500, I would have had $65,000. That same property I bought from you, Ron, 6 years ago with the cash flow, appreciation, and not even including the tax benefits. I didn't even put the tax benefits in there. The fact that I had better, because there are no tax benefits in the stock market ever. Don't think an IRA has tax benefits or a 401k. They have zero tax benefits. You pay that tax someday. Even the Roth is like the closest you get to tax benefits. And even then, you put in $6,000 a year, you're never going to get rich off that crap. So so like I showed my own, instead of 65,000 stock market, I made 165,000 off that one property I bought from you, Ron. Like 165,000, $100,000 more with more certainty and better cash flow. Because if I pull off 3% a year off that 65,000 right now in the stock market, I'm only pulling off about $1,950 a year. But with the current property, we just got the rents increased again. I'm making over $9,000 a year off that same money just 6 years later. And that's tax advantage.
Yeah. And here's the thing. That's in a run where everything went well on both sides.
Mm-hmm.
But when things don't go well, when the stock market crashes, and let's just say same thing like 2008, real estate market crashes, stock market crashes. Here's the difference. And this is just so key. And it's a critical difference that I can't beat home enough. That's 65,000. If the stock market drops in half, you go back down, you made 65, but you had a total, so you'd be right back at even.
Yeah.
Same thing on your gains from your real estate if they dropped 50%. But the difference is someone is still creating equity for you by paying off your mortgage. and you're still getting cash flow. And in almost every scenario, when those two things happen, rents go up. So you're probably getting more cash flow than you were getting.
That's right.
The only way that the real estate isn't better is if you buy it wrong and you have negative cash flow or something like that that causes all of your returns to be negative.
That's right.
Which you should never do, right? That's the main difference. Because as you're waiting for everything to come back up, you're actually making a return. So the difference in your dad's story and the story you just share is that your dad just had to wait. He just had to wait for everything to come back. How cool would it have been if during that entire time he was waiting, he was getting a really nice return on his money in two different ways, plus both of those ways being tax advantaged. That is the main difference.
That's right. I wish I would have known you back then, Ron, seriously, because he did have to work into his 70s until he was forced into retirement. And he's literally, even to this day, just stretching out his dollars as long as he can. He's taking all the Social Security he can get, because if you do save in the stock market, you do need Social Security. Here's what I've noticed, even with the 401k, I'll talk about the match here with this too. But I've noticed even with the match, if you save in a 401k, you max it out at $20,000 a year. When you factor in I think it's conservative at a 5% inflation rate. I know everybody's like, oh, it's 3 or 2. No, it's not.
That's such BS.
Go to
everybody knows that.
You'll see differently, right? You'll see what the real inflation.
You don't
rate
even
is.
need that, Chris. Just go to the grocery store. You know full well. You're listening to this. You know full well. There's no way it's 5%. You know it's nowhere. It's 3%. It is way higher than that because every single person is paying so much money right now for everything. It's insane. It's insane what they have done. Well, don't get me.
It's true.
I'm going to stop. You keep going because I'll get on a rant about the moronic government and we'll go for an hour.
Well, this is the whole problem. We've been taught all these different things that don't work, right? Because you're right. Because if I go back to real life, I remember in 2004, right? My goal when I was a financial advisor was if I can just have $5,000 a month coming in, I'd be set for life at $5,000 a month, $60,000 a year, right? Because then it really felt like making at least $10,000 to $15,000 a month today is what it looked like in my mind. But now it's way different. $5,000 a month, you can't even survive on that anymore. Unless you're living by yourself, no family, maybe the two of you and you're dirt cheap living in a cheaper place, not living in California or something like that, right? It's really hard nowadays to live on $5,000 a month, and it's going to get harder. And I used to think, if I could just get to that point, that'd be awesome. I'll just save $2 million in my mutual funds to hit that, where that you don't have to do that, right? It's just not needed. And so the 401k match is interesting because going back to Fidelity, I pick on Fidelity because they are the number one 401k provider, right? Well, Fidelity, I looked at the performance. You can actually look it up online. I looked at the performance of their target date retirement funds. Right now, about 86% of millennials just automatically pick the target date retirement fund. The ones that say, retirement date 2050, and then it does its own little, kind of diversification, so to speak, based on that. Or if it's 2060, they're almost the same, unless you do 2030, then it might be a little bit more conservative and a lower return, right? Well, if you look at those target date funds, I looked at the long-term ones, the ones that performed the best, they underperformed the market by 2.1% over the last 10 years. Now, they also have, in addition to that, a 0.75% fee on them too.
Yep.
And that's just the basic fee. There's a lot of other administrative fees that can come out of your 401k, that makes it more expensive. So when you factor it all together, you put it together, you're like, that's almost 3% a year. Well, guess what? If you get 100% match on your money long-term and you actually run out the real rate of return, that compounded interest return, it's not 100%. Like I said, you can try to put in $10,000 a year in your 401k, getting 108%, say if the stock market average plus 100%, you'll be richer than Bezos in 20 years. That never happens with a 401k holder. Never, right? Obviously, if there were, we have a lot more than 1.8% having over $1 million in them. But instead, I said, if you put in the match, it actually only makes up a difference of about 2 to 3% a year. So if you were getting, in this case, if the market, does worse, you're only getting 6% a year in your mutual fund, right? In that 401k Fidelity fund. And then you get the match. You're like, cool, that just got me up to over 8% a year. Oh, I could actually do just the same thing investing on my own than not getting the match. The match only just makes up for the bad performance of the fund. That's it. You would actually been doing just as fine in the S&P 500 as you would getting a 100% match. And many people only get a 50% match on their money, right? Or less. They max fund their 401k. They only get up to a certain percentage. So they're like, well, I'll just do it up to the match. It doesn't matter. The performance in those funds are so poor that the match only makes up for the bad performance if you get 100% return. If you don't,
most of them are,
you actually do worse than doing it on your own.
Right?
So,
you're putting 3% in. It's basically a wash.
It is. Yeah. So, I mean, run the numbers. Again, I've done on my podcast before. I'm not doing it here, but when you look at the real compounded interest of what the number actually is, the longer you put into a 401k, the worse the return becomes, the worse the match actually becomes. The best time to have a match is that first year, if you can just take it and pull it out, which I've had very few people, usually people in their 60s, can actually put money in and immediately pull it back out with a match. If you are allowed what's called in-service distributions. In that case, yeah, you can be creative. Because I had a client do that. He went and threw in his money, pulled it right back out, and then bought real estate with it, right?
Yeah,
he didn't care if he had to pay taxes because he got the 100% match and was able to immediately pull it out. That works great. People that put money in stocks, like they might have a company, they work for a tech company, has its own stock. They buy at a 15% discount with their ESOP, as they call it, right? Great. That can work because you can get that money out maybe 6 months to a year later, and then use that to invest outside of the stock, right?
Yeah.
Those things can work. But that's the thing, the match doesn't create 100% return or 50% return like everybody tells you it is. It's actually much less on a compounding basis because they only match new money. They don't match compounded money. And that's why the return is not as big. Another one that you and I have a mutual friend that they started talking about dollar cost averaging, right? Like just dollar cost average. You can't time the market. It's true. You cannot time the market. It's better to dollar cost average than nothing at all. But here's the problem with dollar cost averaging. And maybe you saw this when you were a financial advisor, but I used to have the charts, like
first, tell everybody what dollar cost averaging is, because there might be somebody out there who doesn't know.
Dollar cost averaging means that you're always paying money into the market, no matter what the price is of those stocks or those mutual funds, right? So what they'll show you on the charts, and I should probably just pull it out. You probably find stuff like this online where they'll show you different charts. They'll show you one chart that's going straight up, and you'll see that you're buying as the stock or the market's going up.
Yep.
And then you see one that goes down and then back up to breaking even. Then one that goes down like the Great Depression from like $10 down to $1, and then it goes back up to $4, right? But if you buy it all the way down, when it gets cheaper and cheaper, they're like buy low, sell high, right? So buy it as it gets cheap. So people will tell you, yeah, do that, dollar cost average, because even if it's going down, keep buying. You ever notice there's never a bad time to buy with a financial advisor? If the market's going up, they don't tell you to stop buying. And that chart, it's the worst one. The one that's the worst is the one that goes straight up, right? The one that goes down and back up to even actually matches the one that goes straight up or even a little bit better. The one that makes the most money is the Great Depression, where you buy at the bottom and then as it starts to come up, you make a lot more money. Yep. It's true. It's basically buy low, sell high. Well, if that's the case, why wouldn't I not wait and save up all my money for a market crash, then throw my money in? But they teach you to do it in this kind of market where it's going up, right?
Yeah, it's because
it's actually getting more expensive.
It's because they teach that you're going to get these great returns, and they don't teach anything about, the returns getting completely sucked out of your account when the stock market crashes. And then you don't have anything to go back into the stock market with. You're sitting there with what you had. And
that's right.
Well, half of what you had, or whatever the number is.
Yeah. And then you got to wait for it to come back. And that's why most people, psychology, and I would teach stock trading students this all the time. Like, you got to take your profits and run, right? Like, you sell when it's high. Even if it goes a little bit higher after you sold out, don't look back. It's always hindsight 2020, but don't look back. If you get a profit,
I did that with apartment buildings a few years ago, because people were paying me insane amount of money for, and some single family home portfolios too, because there was these hedge funds that were paying insane. I mean, it was insane.
Oh yeah.
The market would have had to continue to go up for another 5 to 10 years to be able to recoup what they were paying over appraised value. But it was absolutely absurd what they were paying. And at that point, you just got to go, okay, I'm taking all my chips. You can have them at that ridiculous rate. You can have them. And then I'll just go buy something else with them, because you've overpaid so much that I'd be an idiot not to take that money off the table. And it's kind of like that with the stock market. I mean, if you've had a 15-year run, it might do 16, it might do 17. Nobody knows really, but it's done 15. I mean, it's done 15. So your choice.
Yeah, it's just like big gamble. And here's the truth. It's high risk, mediocre returns is really what it comes down to the stock market, right? And I like evidence. I like to know that things work. That's why I always go back to what's the reality of people's lives, because if it had worked, why are people still needing Social Security? This is why I don't think Social Security will ever go away, because there are too many people that need it, right? They will pay into it because they know they need it. And the sad truth is that if they keep putting their money in the stock market the way they've been doing, they're going to realize it's just not enough. And they're going to be the one that blamed. It won't be the financial advisors. It won't be the 401k providers that'll be blamed. They'll be you because you just didn't save enough. But every time I run the numbers, whatever you save per year is what you will live on per year after inflation. You save 20 grand a year by maxing out your 401k, you will live on 20 grand a year in 30 or 40 years. It's sad. It's really sad, especially when you factor in taxes and everything else. You're lucky to walk away with what you've been putting in, right? But when I look at the evidence, I look at real estate. Like, people accidentally become multimillionaires owning one or two investment properties in their backyard. They don't even find a good market. They just buy and hold. If you're going to buy and hold in anything, real estate is definitely more of a sure bet, because that's the thing that, it goes down, but not nearly as often.
Well, and it's never zero.
Is what you see
in the stock market. It never turns into AIG, right? No. It's never zero. Your house can burn to the ground. Your house can burn to the ground, and your real estate's still not worth zero. Yeah. In addition to that, you can insure against the downside risk, right? So you're going to get paid by the insurance company anyway. But even if you didn't have insurance on your property, you didn't lose everything. And there are stocks every year that are just gone. They're not there anymore. And if you own one of those, I mean, if you owned AIG during the crash, it went to zero. I mean, it was gone, right? Real estate doesn't do that.
No. That's the thing. Even a worst case scenario I could think of is like eminent domain, right? Where the government can legally say, I want your property because I'm going to build a freeway through here, and you have to sell it to me at a price. But still, they still have to do it at a fair market value when they sell it to you.
Yeah, which is never enough, Chris, but still, it's not nothing.
No, it's not nothing. Yeah. That's right.
Yeah.
That's the difference. And I'm not saying the mutual funds overall, the stock market will go to zero. It doesn't. Right? We know that the S&P 500 doesn't go to zero.
Yep.
But when you put all your chips into that one horse, and here's the thing that drives me the most nuts, right? Going back to Dave Ramsey. Dave Ramsey tells you to stuff your money in mutual funds. He's like, why don't you pay off all your debt, put your money in that 401k, put it in the mutual funds, and it always works. Okay, well, Dave, why didn't you do that? If you're going to be like an integrity, why didn't you do that yourself? Because Dave Ramsey, although he's claimed this year that he's worth $600 to $700 million, that's because he's trying to overinflate his conference center, which is real estate, by the way. He's overinflating his real estate values, but even when you don't, he's still worth about $200 million, $50 million in his business. The rest of it, about $150 to $200 million in real estate holdings. Yeah, it's not from his mutual funds.
Yeah, he talks about his real estate holdings, right? Yeah, that he owns for cash. And here's the other thing that irritates me about Dave Ramsey. It's not that owning real estate for cash is a bad thing. I own some real estate for cash, and it's fantastic. There's nothing wrong with that inherently, right? But Dave Ramsey has a business that produces tens of millions of dollars a year for him, from which he can go buy real estate for cash.
That's right.
But if you don't have that, and you haven't created that, what do? Because
that's right.
Saving up your pennies until you can afford to pay cash for a house, and then hoping that, I mean, if you do that over many years, right, and then you pay cash for the first house, and then you have to wait for that house to produce another house cash, it takes an eternity to do that. And that is not what Dave did. Dave created a very successful business, and that very successful business has paid for his $250,000 to $300,000 worth, or $300 million worth of real estate that he owns, cash, because he bought it for a good deal with cash.
That's right.
So if you find yourself in the same position as Dave Ramsey, well, then by all means, pay cash for your real estate. There's nothing wrong with that. But if you're not in the same position as he is, and you actually do want to retire at some point, you're probably going to have to leverage. you just as well do it in something that's far more safe than the things that he tells you to invest in. I will also say, Dave Ramsey on getting out of debt, money. If you're in significant credit card debt, you should go through Financial Peace University. You should do exactly what he says. You should work your butt off to get out of that debt so that you're in a place where you can invest. And at that point, you should stop listening to him.
That's right. He gets you out of remedial math, right? Like he's like the teacher for like trying to get you to do basic mathematics. But once you're ready for algebra, drop them, at that point. And that's the thing is that if we go off of what he did, not what he says, if we were to just emulate what people do that actually created wealth, we would say, let's all create a business and buy real estate. That's what he did. He bought real estate. Yeah, he bought it in cash because, like you said, he had enough money and cash coming from his business to do so. But what's ironic, though, even with his business, that's a massive empire, still is only worth about $50 million, arguably. It could be more or less, depending on how people value it, because of his personality. He said he's replaced himself, but not really.
No.
But his real estate, I mean, in the hundreds of millions of dollars, guys. Like, and that didn't happen overnight. That happened over decades for him doing that. But he used his business proceeds to buy real estate. Why shouldn't we be doing the same thing? Whether you have a job or a business, why should we be doing the same thing that Dave Ramsey did? Listen to his little stuff about being in the stock market. I mean, even Susie Orman, again, somebody who's kind of gives that vanilla financial advice too, right? Same with her. When they actually looked at her portfolio, only 5% were in this stuff. So,
and don't get me started on the buy term and invest the difference. I mean, don't even get me started on that nonsense.
Which is taught by insurance companies, right?
Yeah.
Insurance companies love it when you buy term invest the difference because then they make all the profit, because that's where 99% of term policies never pay out because people never die with them.
Because they're 10 to 20 year terms and they know you're probably not going to die during that term. That's the whole reason they're giving you cheap term. It's just math. Anyway. Yeah, Chris, we could talk all day about this, man. I've kept you a long time. I so appreciate you coming in and talking about this, because it's a hot topic right now, man. People don't know what to do, and there's so much just completely diverse information on the internet. And I think what you shared with everybody listening is something that's just common sense. Like, you don't have to be a graduate of Wharton to be able to understand this. You don't need a finance degree. It's common sense. And I very much appreciate if you don't listen to Chris's podcast, you should. Chris, where can they find you if they want to look you up and check out what you're doing?
Yeah, I mean, you can find the Money Ripples podcast on Apple Podcasts, YouTube, all those places. You can even find us at moneyripples.com.
Awesome. We really appreciate having you here. And until next week, everybody, get out there and make something happen.
This has been the Get Real Podcast. To subscribe and for more information, including a list of all episodes, go to getrealestatesuccess.com.